Hello, everyone. Today on the final bar, we're going to talk about market recovery, market upside, with the S&P really stepwise moving upwards through the course of the day. News this afternoon really pushing the S&P to close near the highs above 3,400 for the first time in a little while here. Looking at the hourly chart, you can really see it testing the upper end of where we've been since the first initial sell-off after the September high. So what's leading, what's working, and what isn't? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets together through the lenses of technical analysis, behavioral finance, quantitative analytics, market behavior, investor psychology, all of the above. And the goal is to see what we're seeing today and relate that to the longer-term trends, how they're evolving. As we've talked about many times over the course of our time together on the show, you know, the goal of the investor, the individual investor for sure, I would say is three-pronged. It's identifying trends, it's following those trends, and it's anticipating when the trends are reversing. And, you know, from what we've seen in the short term today, for sure, finishing at the strength of the day, following through to the upside, testing the upper end of this resistance range that we've talked about, we're very, very close to, I think, signaling further upside, return to the previous highs. We'll have to see how the remainder of this week plays out. Now, coming up on this week on the final bar, we have some wonderful guests to help us navigate things together. Tomorrow on October 6th, we have Jay Hatfield from Infrastructure Capital Advisors. On Wednesday, Willie Delwich from Robert W. Baird. And on Thursday, the 8th, JC Peretz joining us from All-Star Charts, coming back on the show. Be very interested, especially with Willie on Wednesday. You know, who's certainly more of a macro strategist and economist with sort of a technical overlay and, you know, sort of a momentum-based input at some point in this process. Interesting for him to think about, you know, what the macro headwinds and tailwinds are related to the election, related to the Fed, related to, you know, the overall market environment as we think about these trends and what they're telling us about where people are placing their bets. So some great guests coming up this week. Now, looking at the market recap, I'll be honest with you, right? Friday, we do a wrap the week segment where we look at all the, the evidence. We have the Mindful Investor Live chart list that we went through. And, you know, to be honest, I would say that review in particular relative to previous weeks has looked not overly positive, but certainly a lot less negative. Things didn't look negative as much as they looked neutral, right? The breadth lines, which we'll look at here in a second. You know, if you look at the cumulative advanced decline lines on the S&P 500, you know, they're not horrible. They're not great. They're sort of neutral. So I color-coded two of them, the amber neutral color, two of them still remaining red because they haven't seen a new swing high yet and are still making a lower low. So, you know, seeing if they can make higher lows, I think would indicate a little more constructive posturing. And small caps and the broad NYSE are the two that have not sort of triggered more of a neutral signal yet. But overall, you know, it's going down a lot less than it was before. It's representing this upswing over the last week or two as there's been demand. There's been an exhaustion of sellers or an influx of buyers, or however we would want to describe the characteristics of what we've seen. What really struck me, though, as I was getting ready for today's show is when I was doing the bottom-up part of the process, which is yesterday into this morning, looking at the individual charts on the S&P 500. There are a lot of charts that actually look pretty good, pretty decent, that are either breaking to new highs, things like solar stocks or home builders or some of those, a lot of technology names, a lot of consumer names, or it's things that have pulled back and now starting to bounce back higher. So, you know, Gap, GPC, and consumer discretionary. GPS, excuse me. GPC is in auto parts, bouncing off the 50-day moving average. Alphabet bouncing off its 200-day moving average. You know, there are charts where the price has pulled back to key levels and now rotating higher. So having said that, we're going to go today through each of the three pieces, start with the macro environment, and then look at the sector rotation, and then finish up with bottom-up stock picking. Let's set the stage by looking at the dashboard, seeing where things played out. So the S&P back above 3,400, which is a significant level we talked about for sure. These were the previous highs from the peak in February. You can see down here, mid caps and small caps outperformed today, up over 2%, while the S&P was up 1.8%. The Nasdaq 100, the best of the or the bunch, or tied with small and mid caps, I guess, up 2.25%. In terms of other asset classes, very quickly, definitely a rotation away from bonds into stocks today. We're going to look at that ratio in a little bit if we have time, but bonds down 2% in the form of the TLT, weaker dollar with the UUP down 0.4%. Both of those really came off of the much lower open today from where they were on Friday. 10-year yields back up to 76 basis points, 0.76%. And metals, though, is interesting. When we think stocks go higher, gold and the defensive trade sort of comes off. Not the case today, though. Commodities and stocks actually moving in lockstep, with silver up over 2%, GLD, gold up about 0.5%. So all those sorts of patterns that have been pulling back, in particular gold stocks rotating back higher, sort of illustrating a bid coming in at the lower end of the pullback range. So interesting as these now start to test more of the upper end of the range, and now it's a question of whether they're able to follow through to the upside. Let's look at a chart of the S&P 500 because we're going to dig into some of the other metrics a little later. Here's the chart as it stands, and what we've talked about is this. Here's the move to new highs, the peak around 3,600 in early September, and then much of the month of September was a story of weakness, with the S&P going back below its 50-day. A lot of stocks doing the same thing, but we broke above trendline resistance just over a week ago, and this is last week. These last 5 bars here started with a gap to back right to the 50-day and continued to remain about those levels. Today, we've arguably followed through outside of that range. I think now I have this purple dotted line, which represents the highs from early in September, that first reaction off of the sell-off at the beginning of last month. And if we're able to get above there, which is just a couple points away from where we closed today, that's very close to, in my opinion, signaling a return to 3,600 is, you can assume that that's most likely to happen. You look for pullbacks, look for breakdowns, but overall the trend is more positive than negative. And I think today potentially began the beginning of that next leg higher. So, a lot of the negative patterns that we saw, we talked about a pullback to 3,200, 3,250. Perhaps that was enough, and perhaps we're making the next leg on the return to previous highs. I think that's possible at this point for sure. Now, what would change my mind on that, which would tell me that that is incorrect and that we are going to continue steeper, I think, or steeper to the downside. I think at this point we've established a very clear support range. It was clear to me before a couple weeks ago when we bounced off of it, but this just further confirmed that 3,200 to 3,250 range. On any sort of pullback, I think that is the ultimate line in the sand for stocks, and that's what differentiates more of a constructive longer-term pattern versus a potential to go to further swing lows. And that's certainly the level I would look for on any sort of pullbacks. Again, as we get to some of the individual names, though, overall the patterns are fairly constructive, and you have to acknowledge that for sure. We talked on Friday about the market trend model, so I don't want to beat it too deeply, but just to say that as of the close, it continued to finish on Friday, still in bullish mode across the board. So you have long-term, medium-term, short-term, all leaning positive. That's all very constructive. The one that's very close to turning negative is this weekly PPO, the weekly MACD model, which is a very traditional trend-following model, giving you that intermediate term trend. It's right around the zero line for the last couple of weeks, but really hasn't triggered just yet. So overall, holding in there okay. I did want to just hit very quickly, and then we're going to move on to our next segment, is just the chart of gold. So what's happened now is the GLD has come down. It's so far bottomed out just above this support range that we talked about. So I think that's overall pretty meaningful, and that's certainly where I would look for on any return back to the lows. Now we're actually testing the support that was through much of August and early September. We're now testing that from below. So if we're able to get above there, get above the 50-day, that sort of clears the way for further upside on the GLD. This could be a natural time for gold to roll over, and that's why it's a pretty important level. A lot of times we talk about resistance levels becoming support and the opposite, and this could be one of those times. That's why we're at a pretty meaningful Fibonacci level for the GLD. That's our market recap for today. We're going to continue on our progress through starting with the macro, which we've now done. Let's go to sector setups and focus on sector movements and how they've related to one another. Let's look just today at what happened, and then we're going to look at some of the relative rotation graphs and individual sector charts to complete this this mosaic. So energy actually led the way higher today. Oil prices up pretty big today. I didn't mention that in the early recap. Forgive me for that, but oil, the USO up 6%, crude oil, finishing pretty strongly. That pushed energy up pretty significantly, up 3%. It was the number one out of the 11 sectors, followed by technology and then healthcare. On the downside, you have some pretty defensive areas like real estate, consumer staples, utilities. Kind of surprised to see consumer discretionary at the bottom, only because when I'm reviewing the individual charts, a lot of the really impressive charts are in consumer right now, in consumer discretionary in particular. So a bit of a divergence from what you might have expected, but overall, again, it's one day's action we're breaking down here. But energy certainly the story in terms of a strong up move. Now, the kicker, as you look at the preview chart, is that's coming off of a very, very extreme low level. That's one of the things that I notice if you ever use the Scooter reports like I do here. We have the top stocks, which is just always good to know. What are those top 10? And if I don't own them or like them or follow them, why not, right? These are stocks that are in established uptrends that are holding up pretty well on a relative basis according to the methodology. But these are the stocks that are increasing the most in their Scooter rankings today. These are the stocks that are decreasing the most in their Scooter rankings today. And a lot of times, sometimes there are some really impressive charts that come off here and you think, wow, that's actually a really decent, chart. Of course, I'm like, Westrock potentially, right? Sort of breaking out of this little congestion range, kind of a nice chart. But a lot of these are actually coming out of really depressed levels. So like Halliburton, for example, looks a lot like a chart of the XLE. Nice bounce from 1050 up to 12 in a couple of sessions. Absolutely right. But coming out of an extreme low level. And as a trend follower, I'm much more interested in a Halliburton once it's established a bit of an uptrend. So I think with energy, arguably with a lot of financials as well, you have these stocks that have been beaten down pretty deeply. Airlines were in this list earlier today when I looked. Those are stocks that are coming out. They're still in pretty rough trends overall, fairly negative, especially on a relative basis. So certainly increasing and improving is good in the short term. Seeing meaningful, sustained improvement that cause the longer term trends to turn higher. That's what would really be interesting for me. Let's look at some of the sector charts in particular. Let's start with the relative rotation graph. So this is the daily RRG, just showing us the short-term movements over the last week or so. And the story here has really been about a week or two ago, these were essentially vertical. You had communication services and technology over here heading essentially due north. And then most other things, excluding energy, because I think it's the outlier pariah of the 11 sectors at the moment. But if you look at the rest of them, they were sort of heading due south in this area. What's happened in the last week now is you've seen some further rotation and now really moving in that clockwise direction. So things that are improving. Technology now back in the leading quadrant, which is pretty meaningful. Consumer discretionary rotating back in the leading quadrant. Utilities, the strongest of the 11 S&P sectors right now, which is actually really important to be aware of. That's traditionally a defensive sector, but actually doing pretty well right now on a relative basis. Real estate has made quite a 180 going from southwest to northeast, and that's a potential emergence to pay attention to. Things deteriorating: financials, industrials, materials, consumer staples, healthcare, all sort of rotating in that southwesterly direction. Now, if we look at the weekly view, again, this is a little more of a longer term view. This is where we get some of the broader changes in relative rotation. This is where the emergence of industrials and materials as strength come to bear, but I think you see materials rotating down to the lower left direction, entering the weakening quadrant very soon. It looks most likely to happen. It's interesting, within that sector, we're going to look, if we have time, at some of the charts like International Paper, like Mosaic, or actually a PPG, are actually pretty decent charts within there. So I think with each of these sectors, there are opportunities. It's all a question of just finding them. Industrial still on the longer term basis holding up okay. I think the really interesting charts over here: consumer discretionary, technology, which remain furthest to the right. Technology has been in the weakening side of this, with a lot of the names within there pulling back in that shorter term time frame. But overall, would be interested to see if that continues to rotate further to the right. Looking at some of the individual sectors on here, I mentioned utilities earlier, and I think it's worth noting this is a sector that's potentially breaking out of a pretty big base. So if you look, it hit the 200-day back here in April. This is coming off of the March lows. From there, the relative performance really deteriorated and it was flat in price. This is when, as everything else was really rallying and continuing the uptrend through the June peak and then continuing on into an eventual high in September. Utilities actually topped out when the market topped out in June. From there, it's been essentially flat. So overall, the trend has been stagnant. I would argue it's now gotten above its 200-day moving average. It's now threatening a new closing high for the last 6 months. But I think what's most interesting is this relative strength profile that's rotated from distribution to accumulation. We've seen follow through now more and more on the upside. So with the price breakout, with the relative breakout, and with the yield component, this is a sector that tends to yield much higher than other sectors on average. Maybe worth a review, even if you expect further upside. There are plenty of times when the market does well and utilities are doing well as also. Industrials potentially bouncing off of the 50-day moving average. This was Friday's bullish engulfing pattern. Arguably, it depends on what you think of this trend going up here, but certainly accumulation during the course of the day leading into the weekend, follow through to the upside. So while the relative strength overall is not incredibly positive, overall the longer-term trend remains positive. This is why the RRG chart is aiming up in a pretty good way. You'd love to see this get above 80 to really feel like there's an upside follow through with industrials. Not quite there yet. We're going to talk about consumer discretionary in a little more detail. And out of all of the sectors, in terms of most impressive charts and the sector chart that is working, consumer discretionary would be hard pressed to find one better than that. Even technology, to be honest with you. If you look at the relative strength of consumer discretionary and technology, they're essentially very, very similar over the last little stretch here. The relative charts look the same. The ratio chart is essentially flat. This has been a nice, consistent outperformer, and the pullback to the 50-day looks very much like a bull flag pattern, which would measure a lot higher than what we've seen so far. So potential green shoots, bright spots in consumer discretionary. We need to take a quick commercial break. We're going to be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We love to hear from you, love to answer your questions. We're going to do another mailbag segment tomorrow on Tuesday's show. A couple ways to get questions our way. Number one, via email, thefinalbar@StockCharts.com, on Twitter @FinalBarSCTV, or on YouTube, just put a comment below any of the videos that you're watching. We love to hear from you. Feedback on the shows, feedback on the channel, feedback on the hosts, especially this one. Or most importantly, questions that you're running into, questions that emerge naturally from your process of discovering charting and technical analysis, looking at particular tickers, particular visualizations. Nothing is out of bounds. Please feel free to send us your questions, and we'd love to answer one of your questions tomorrow on our next mailbag segment. Our next segment today is called Shifting Stocks. So now we have talked about the macro environment, top-down approach. We've now talked about sector rotation, identified some of the emerging strength in places like utilities, industrials, consumer discretionary. Now let's look at the bottom-up portion of this. And as we've talked about a number of times, part of my weekly process, which really goes through today, is to go through the S&P 500 stock by stock and look at the individual patterns. And I find looking at the broad market, looking at individual sectors and groups, looking at particular stocks and themes through the course of that weekly routine, it's hard to get caught off guard with what the patterns are doing and how they're evolving. At least that's the goal of all of this. So I wanted to just highlight some of the patterns that emerged in my review of the charts. So we'll go quickly through as many tickers as we can get to. The first ticker in my list, just naturally, because I do it by sector, and I start with communication services, and I do it by group, which starts with the entertainment group within communication services. Charter Communications, CHTR, is always the first chart I have up. And so I find I potentially know it the best, because that's when I bring up and I get distracted and I just leave it up on my screen. That's a reminder to keep doing the stock review. And what's interesting is if you look at this chart, again, all else being equal, pretty positive chart. Overall, higher highs, higher lows. It's threatening a new closing high. Made a new 52-week closing high last week on Thursday. Didn't quite get there, but that's definitely matched the all-time high there at 640. and overall holding up very well above two ascending moving averages. So, again, until that chart starts to look negative, there is at least one bright spot out there in the equity universe for sure. I think you'll find very quickly there are many. It's not this one alone. If there's one thing that concerns me with this kind of chart, it's the divergences that happen. And again, it is not. There are plenty of times when a divergence does not play out and it resolves to the upside, and potentially that may be what's happening here. But higher highs in price met with lower highs in momentum is always a potential bit of concern. But overall, again, as long as the price continues higher, I'm feeling pretty good about that. Other charts of interest within communication services, AT&T and Verizon are in this fixed telecom group. AT&T is probably one of the worst ranked stocks within communication services. It's on a price basis, certainly weaker rather than stronger. Verizon, certainly a different look, and it's testing an ascending 50-day moving average. It's been riding this higher for the last 2 weeks or so. So seeing that hold would be pretty positive. I think that's what you certainly want to be looking for if you like potential upside in that stock. But it's right at sort of that key level. Google has bounced off of its 200-day moving average, and in terms of lines in the sand, things that would tell me that the world is not all okay and that I need to be thinking more risk potential to the downside would be a stock like Alphabet breaking its 200-day moving average. It pulled right down to it there in mid-September. It's now bounced back up. At this point, that's your clear line in the sand, just like the S&P in that 3,200 level. That's sort of that same level for Alphabet. Interesting, one of the 3 and 3 charts I think you're really going to like, it's looking at the long-term performance in the video game manufacturers, video game producers. But it's worth noting that both Activision and EA, Electronic Arts, are actually a little weaker in the short term. They're making this pattern of lower highs. So while other things are sort of rotating higher, breaking to new highs, testing new highs, sort of bouncing off support, these have actually been, breaking support levels, breaking the 50-day, not really staying back above their Friday when most things were up. It was actually down a pretty good amount. The RSI is remaining below 60, so it's a little more distributive, and EA is a very similar look to this. So I think that's a group that, while the long-term charts have been pretty positive, they're certainly showing some potential weakness on a relative basis. Twitter is one of the many charts out there that you'll find making new highs up 2.5%. So when we look at that 52-week high list, I think we'll certainly see it pop after today's data is digested. But a chart like Twitter is a pretty strong longer-term trend for sure. Within consumer discretionary, I think that's where you're finding some really impressive charts. I'll go quickly through these, but just to highlight stocks continuing to make new highs and new lows. Gap comes to mind. L Brands, ticker LB, is a good one as well, making new swing highs in the last week. Target is arguably one of the better charts out there, continuing to push higher. Ross Stores, ROST, is an interesting one that's actually just reclaiming its 200-day moving average. So a little different than some of these really extended names. And I'd love to see if this is able to break to new swing highs, break above its 200-day RSI, get above 60. That would be more indicative of a longer-term uptrend. It's not quite been able to do that. And then I mentioned GPC earlier. This is part of a group of stocks that have pulled back to the 50-day, now bouncing off of it a little bit. With some of those names like LB, for example, they're overbought right now, and that's what I would be looking for there, is if, at some point they start to feel a little too extended. Solar stocks are worth mentioning. Solar, I was actually talking to our data team earlier today. We actually bucket them in a couple different places, and I'll be honest, working at a large buy-side institution, no one really knows what to do with solar. They're kind of industrial, they're kind of technology, they're kind of energy-ish, depending on how you think of it. It's sort of this weird group that doesn't make sense anywhere. So people usually try to just find a place where we bucket most of them within technology or industrials or energy. We're sort of debating what to do with it right now. But FSLR is First Solar, is one of the larger names in the space that you might be aware of, just breaking back above its 50-day moving average. Now, TAN is the ETF that's a pretty good bet, pretty good exposure to solar stocks, and that has been making consistent new highs, up another 6% today. Extremely overbought and with a pretty impressive long-term relative performance. So usually that means a bit of a pullback, but at least one more push higher is sort of the base case for that. Materials as a sector isn't the most ideal chart, but there are some individual stocks within there that actually are setting up pretty well. IP is International Paper. It's potentially making this sort of short-term pennant sort of pattern, arguably just resolving to the upside if you connect the trend line using those previous highs. So it's potentially a continuation pattern pushing to new highs there. MOS is Mosaic. This just bounced off of its 50-day moving average on Friday and now falling through to a bit of the upside. PPG is within specialty chemicals, looks similar to some of the other charts we've looked at, bouncing off of the 50-day moving average. So I think, again, even with a sector that's a little challenged in the short term, there are plenty of individual stock opportunities in a lot of different places. Just want to finish off talking about technology and a couple, there are many charts that I'd love to go through. CTSH Cognizant looks similar to some of the charts we've talked about. PayPal is an interesting one too, PYPL. This is sort of a little different. It's just trying to get back above its 50-day moving average. It's just one of those, recovery names, sort of the work from home names that, had been doing very well, sort of floundered a little bit on a relative basis over the last month or so. Has not made a new high. It's back above its 50-day, which is kind of similar to the S&P. And I think this is an interesting name to continue to watch for sure. Apple is another one with a very similar sort of pattern where, it's not a beautiful, clean bouncing off the moving average. It sort of violated it and made it feel like this was starting to get a lot worse very quickly. They've all sort of come back to those levels and seeing if they're able to hold the 50-day, hold support on any sort of pullback. So something like 105 on Apple would be really, really important, I think, for a number of these charts. And just to remind you again, I tend to hit on a lot of really beautiful charts because I'm always looking for potential upside on charts. But I would tell you there are plenty of stocks that are weighing a little heavier. IBM comes to mind within technology with an RSI that's flat, with a price that's flat, and flat price over the last couple months means your relative strength is really getting hurt. So within sectors that are doing well, like technology, you still have the haves and the have-nots. So I think screening, looking for opportunities now more than ever, really, really valuable for investors. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. This first one I think you'll like. There was an article in Barron's over the weekend talking about the long-term performance of the video game stocks. It was talking about Activision, Blizzard, ATVI, Take-Two, Electronic Arts in particular. But it was talking about the long-term performance, and I just created a chart to visualize the performance. This is starting the clock in mid-November of 2001, which was when the first Xbox was released. And that sort of ushered in this, the current era of consoles, if you will. I mean, there have been many news stories along the way here, but if you look at the long-term performance, if you start there, Activision up 2,700%, and this is all on an adjusted basis. Take-Two up almost 1,700%. EA is the outlier, still outperformed the S&P, but not by much, a mere 40% or so. But overall, an equal weighted version of these are right around there, right around plus 1,700% over that time. That's when the S&P is up 330% and the Qs, the NASDAQ 100, up 700%. So an interesting chart showing the strength and the long-term appreciation on some of those video game makers. We talked about solar stocks in our last segment, and just to remind you that TAN, and again, there are plenty of stocks within this group that may be worth looking at, but TAN, TAN is the solar ETF. It's pretty good pure play on the solar theme, and again, those stocks tend to be bucketed in a number of different places, but overall, similar sort of theme. With TAN, the positive is strong price performance, higher highs and higher lows, strong relative performance, up 100% plus on a relative basis versus the S&P over the last 12 months. Potential downside or potential concern is the fact that it's extremely overbought. It's gotten pretty far away from its moving averages. You look at the percent of the price relative to the 200-day, pretty elevated. So again, you'd expect a bit of a short-term pullback. I think a pullback to like the 50-day moving average would be an ideal sort of thing, similar to what we saw there in early September coming off the market highs. But overall, still in pretty good shape. Our final chart is showing you small caps versus large caps. This is the IWM versus the SPY. And if you look, the big outperformance of small caps came March to June. After the June market peak, there'd been a short-term cyclical pattern, but overall, look at the ratio over the last 4 months is literally dead even. And that's interesting because I have tended to think of at times it's a mega cap led market, and maybe they're in late July, early August. That's what it sort of feels like. But you can see that the long-term trend essentially flat. So again, what this tells me is certainly a stock picker environment where you have opportunities even within mid caps and small caps that are holding up very, very well. So good argument for screening. Folks, that's our show for today. I want to thank you so much for joining us every weekday after the close for The Final Bar. Get your questions to us via email, thefinalbar@stockcharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.